following podcast was recorded on Tuesday, January 23rd, 2024, featuring Jim Bianco of Bianco Research. To hear the podcast in real time, you can sign up for a free trial at biancoresearch.com or arborresearch.com, or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome everyone to Talking Data. I'm Kristen Radosh with Arbor Research and Trading, joined today by our commentator, Jim Bianco of Bianco Research. Welcome, Jim.
Thanks for having me.
This is our first podcast of 2024. And today, Jim is going to discuss goods inflation. Is it about to make a return? Jim, we live in a just-in-time inventory world, and delays to inventory deliveries run the risk of increasing goods and goods inflation. So what is the latest with shipping?
Yes, and that's exactly it. And I do want to emphasize what you just said and then go into shipping. This is not about the fear that your goods and your container are going to fall in the ocean or the ship's going to sink and you're not going to get it. You're going to get it, but as you said, in the just-in-time world, getting it late causes problems, causes shortages, and people pay more when there's shortages, and that's goods inflation. So with that, where are we about getting it late? So the first image I have, we're going to go high school geography here right now, is a map of the globe, and it shows you a green line on the map of the globe, and that is the distance between Singapore and Rotterdam. And that distance between Singapore and Rotterdam is 8,500 miles. And as it says, it will take about 26 days to make that trip. Well, now you have to go around Africa. And as it says in the bottom, that now goes from 8,500 miles to 11,800 miles. And it's a 36-day trip. And so it adds 10 days to the trip right there. The freight forwarding company Flexport is already estimating that something like 600 ships have now been diverted since the start of this whole thing going around Africa, with something like 2 to 3 million container boxes have been diverted. Now, where is the problem? That goes to the next chart on the list, and this is, or the next graph or geography, and this is the end of the geography. At the southern end of the Red Sea is where Djibouti and Yemen meet together. That little boxed area on the top is blown up on the bottom. It is referred to as the Bab el-Mandeb, which translates roughly into Gate of Tears, and that is an appropriate name for it. It is 16 miles wide at its narrowest point, and this is where the Houthis have this control of this part of Yemen, and this is where they're staging their attacks on shipping in the southern Red Sea, forcing all of these ships to go around. Now, talk about why they're going around and what's going to cause that later, but let's jump to the next chart and talk about the impact that they're having. This chart and data comes from the IMF Port Watch. So the International Monetary Fund brought up a port watch where they look at both what's called AIS and automatic information signal, I think is what AIS stands for, in satellites. That's a GPS. Every ship has a GPS, a global GPS. And they track the number of ships that are moving around the world at any given time. And they've been putting together a number of data points. One of them is the Bab el-Mandeb. And what they do, which I think is more relevant for our discussion, is they show it in metric tons of volume. So how much stuff is being delivered, not necessarily how many different boats or ships are delivering it. And what you see, this is a rolling 21-day average. It is really fallen off a cliff. It has gone from 5 million tons. That's 5 million tons of stuff a day was going through the Bab el-Mandeb to 2 million tons a day is going through the Bab el-Mandeb. That used to be, if you want to think of it in a different term, about 80 to 90 ships a day went through that little 16-mile passage. And now we're down to around 30 or 40. And really what the volume numbers show is that the bigger, more expensive cargo ships, and I'll talk about that in a second, tend to want to go around. The cheaper ships and the smaller shipping lines tend to try and, go full steam ahead and kind of shoot through without having any kind of trouble. So that's what's happening at the southern part of the Red Sea. If we go to the next chart, this is the Suez, the northern part of the Red Sea, where you go from the Suez into the Eastern Mediterranean, and you see that it is dropped off by not quite 50%. Now, the difference is that in the middle of the Red Sea is Jeddah, and that is a giant port and an oil terminal for Saudi Arabia. So you could go through the Suez to Jeddah, fill up, go back up through the Suez, and never have to go down where the Houthis are. So you're getting a little bit more traffic through the northern end to the southern end. But the point here is there has been a huge drop off of shipping around there. Where's it going? The next chart shows the Cape of Good Hope. And I will assume that we all got at least a C in high school geography, and that we know that the Cape of Good Hope is the southernmost point of the continent of Africa. And you could see that this chart shows that the number of metric tons transiting past the Cape of Good Hope has spiked in the last couple of weeks as well, because that's where the ships are going, and they're all going to get late. Again, this is about being late in a just-in-time world. Now, what's been happening in that lateness is companies have been announcing various delays and shutdowns and idling of production. Michelin and Volvo and Tesla have all said that somewhere in early February, they're going to have to shut down production because they know what they should have for a just-in-time world, and they know that in early February, they won't have it. So they're going to have to shut their production down. Other companies, even IKEA, have said, not yet. We're not sure if there's going to be a production shutdown. And we're all hoping for this. Now, you may say, yes, but this is a Europe problem. This is not a United States problem. Oh, but it does impact the United States for a couple of reasons. So if we go to the next graphic, this shows the Panama Canal. Okay, now we're back to 7th grade geography. And it shows you that the Panama Canal is about 80 kilometers, or about 50 miles in length. And on the bottom half, it shows you how the Panama Canal works. It's a series of locks that raises up the boat to Lake Gatun, and then a series of locks that lower it, back down the other side. Every time the Panama Canal is used, these locks draw water from the lake, and the equivalent of about 400 swimming pools of water gets drained into the ocean. Now, the Panama Canal opened in 1914, and this has been the case since 1914. But there's a problem, and that's the next one. The lake level of the Panama Canal is extraordinarily low. It's at 81 feet as opposed to 87 feet. This is the rainy time of year. It should be at its highest point of the year in February, and it's already 6 feet below normal, and that might be the highest point of the year. And so what's been happening is the number of ships that can traverse the Panama Canal, first of all, they can't draft. Draft is how deep in the water they are. Some of the bigger ships can't draft all the way down because the water levels are not deep enough. So they either have to come through partially filled, or they have to unload on one end, put it on a train it to the other end. The ship goes through and reloads on the other end. Adds cost, adds delays as well. So if we go to the next chart, you'll see that the Panama Canal, the amount of volume going through the Panama Canal has dived too. And it's well below where it was when we were shut down in June of 2020 during COVID. So why do I bring this up? Because what have shippers been doing to compensate for not being able to go through the Panama Canal because of the low water levels caused by the drought? They've been sending stuff westward through the Suez to Europe to then put on another ship to send to the United States. Well, all of a sudden, that's a problem now. So something like 35% of all of the containers that are going through the Suez, or should have gone through the Suez, which are going around the Horn of Africa, will wind up in Felixstowe, which is the biggest port in the UK, or Rotterdam, or Genoa, Italy. These are the giant European ports. And then it's put on another container ship and sent to New York, or New Jersey, or Charleston, or Savannah, or Norfolk, or somewhere on the East Coast. So people will say, but I haven't seen this in the US. And the answer is yet. It's coming. And the longer that these delays and snarls continue, the more you will see it when we get to maybe March or maybe April. It will show up, but it is coming. Maybe not as severe as it is in Europe, but it is definitely going to start to, it's definitely going to start to show up.
So given all of that, Jim, how is it going to impact prices?
So the next chart shows containers. So the container, a 40-foot container is that box that they ship on a container that looks like the back of a semi-trailer. And this is now 70% of all shipping, these big container ships, 70% of all shipping is done via a long-term contract. So the ship that goes, in my first example, between Singapore and Rotterdam, it'll just go back and forth 6 times a year. It just makes the same run all the time. Well, now that it has to go around Africa, that adds 10 days one way or 20 days in the round trip. It can't go 6 times a year. It might only go 4 or 5 because of the extra time that it needs to go around and unload and reload with empty containers and then bring them back as well. So you'll have to contract excess shipping capacity on the spot market. That's what you see in all these charts that you're looking at, is how much is it for the shippers to say, you know, my ship that went around Africa, it's going to be late. I'm going to have all these other containers I got to ship. So let me call up a shipping company and say, you got an extra ship that I could contract out to fill that other ship's spot because it won't be here on time. And then the question is, yes, we do. How much is it going to cost me to contract that ship? And the price is per box. And what it shows you is it's gone from $1,600 for a 40-foot box to $3,700 for a 40-foot box in 3 weeks. Or as the bottom panel shows, the price on the spot market is up 127%. Now, what does that tell me? 2 things. One, the shippers are basically telling you, we're going to run out of ships here because they're going to be busy going around Africa. We better grab excess capacity now, and we're going to pay up for it because we know our customers are going to pay up for it too, because they're not going to say, oh, $3,700 is too cheap. Just let that container sit on the dock in China for another month or 2 until the price comes down, and then eventually we will ship it. Nope, they're going to pay up for it as well. So that's what you're starting to see in the higher shipping costs, that there is a tightness coming in the market. Now, if we go to the next chart shows goods inflation. It shows you it broken down into 2 different types of goods inflation. Durable goods, which is in orange, which is defined as anything that is supposed to last for at least 3 years, a washing machine. And then it's non-durable goods, anything that is expected to last for a year or less. Batteries, they're not expected to last for a year or less. You expect it to wear out after that. And it shows you that in 2022, when we had the problems with the supply chain because of COVID, that stuff inflation, as I like to call it here on the chart, spiked to a peak of 20.37% for durable goods and 16% for non-durable goods. And it then quickly fell back down to somewhere around 0. But what it did was it did have a big effect. So if we go to the next chart shows us a breakdown of inflation. And in the middle there, so the black line is the inflation rate, 3.4% in December on a year-over-year basis. And the blue part shows you how much of if it is services, X energy. Energy is its own category. But I want to focus on the red part. The red part is good stuff. Roughly 24% of what we spend our money on is stuff. We buy stuff. The other 76 or 75% is we spend our money on services. But even that, I mean, a service would be an airplane ticket, but somebody had to buy the airplane, so there's stuff that went into making the airplane, or a doctor's visit or a specialist visit. But somebody built that billion-dollar hospital complex and somebody built that MRI machine or whatever else they were using for your specialist exam. So there is stuff involved in it, but we don't pay for the stuff. We pay for the services. But you could see that if you look before 2020, the red part of the chart was essentially 0. Goods inflation was non-existent. And then during the 21 to 22 place, goods inflation blew out to about 2.5% of overall inflation. And now it's back, as the chart shows, to literally zero again. If we're going to have another shortage, we're probably going to see another uptick of goods inflation. Now, Oxford Economics, affiliated with Oxford University, has done an estimate, a first cut estimate. There's as good as any. They said if these disruptions last to the end of the year, it will add 0.7% to CPI. Now, do the math. If it's only 24% of CPI and it's going to add more than 7%, what they're saying is goods inflation will go from zero, goods inflation will go from 0 to about 8% on a year-over-year basis, adding about 0.7% or so to the overall headline of inflation. So it will be significant if it continues for a longer period of time.
Jim, when do things return to normal?
Well, that's a good question. And it really comes down to really what is the problem here? The problem is in the way that shipping works, and in particular in insurance. I've been reading about this. I've been talking to people that are knowledgeable on it, and I find it kind of interesting. During the Revolutionary War, the shipping insurance, by the way, let me back up. Shipping insurance started in the 13th century in Italy. So this stuff has been around for a long time. As a matter of fact, London as a financial center was really formed around Lloyd's of London in the 16th century, and in part around providing shipping insurance. And so shipping insurance used to be, I wanted to insure my ship and my cargo that it goes from point A to point B. Well, then in the 17th century, we started running into problems, and the problems was political, and that was piracy. And all of a sudden, that became a problem for the insurance underwriters because pirates would step in and they would steal the ships. So they broke out the insurance into what's called sea risk and then what's called war risk. If you want an analogy of it, think about your auto insurance. There's collision insurance. I'm insuring the car, the cost to fix the car. That's your collision insurance. And then you have your liability insurance. That's all the other unintended things that might happen. You damage property, injure other people, you get injured yourself, loss of work, loss of opportunity. That's all part of your liability insurance. Well, that's what war insurance, roughly speaking, is in the shipping industry. So what's been happening is the shipping insurance, the sea risk insurance, isn't going up a whole lot on shipping, but the war risk insurance is going up a lot. In fact, by some measures, the war risk insurance is up 10x or 20x. So if you have a $100 million cargo ship and it's carrying $200 million of goods, and they can, your insurance cost probably went from something like $250,000 to $300,000 to insure that ship for that one voyage to $3 or $4 million to insure that ship for one voyage. And the shippers are saying, I don't want to pay the extra $3 million to save 10 days. I'll pay the extra fuel cost and time that I'm going to pay my crew to go around the Horn of Africa, because that's not going to cost me $3 million. And so their reason that they're doing this is purely economic, driven by war insurance. By the way, this is not new. War insurance drove shipping during the Civil War. It drove shipping because of U-boats during World War I and World War II. It drove the shipping decisions in the 80s when the Iran-Iraq War were shooting at tankers. It always does. So while the US and the UK military are doing military actions against the Houthis in Yemen, and they're proclaiming them a success, and look, they are, in the US and the UK military are top notch, and I have no doubt that they are achieving their military objectives. What I think is lost on everybody is who is the intended audience to get shipping back into the Red Sea, to get just-in-time inventories back to normal. The answer is Lloyd's of London and shipping insurers in London and in New York and in Genoa, Italy, another place. And right now, those shippers are not seeing anything that's happening with what's going on in Yemen against the Houthis to cause them to want to lower their insurance rates. In fact, it's the opposite. Late last week, they announced that they don't even want to write insurance policies for ships that are either owned or flagged by the US, the UK, or Israel. They will write them if you're owned and or flagged by another country other than those three. So now we've got an upside down world, because one of the biggest shippers in the world is COSCO, and COSCO is a state-owned shipping company in China. And the Houthis have already announced they will let Chinese ships go through without incident. Chinese ships are going through. Russian tankers that are violating the sanctions, that are bringing Russian crude oil from the Black Sea to India and China, who are buying them, the Houthis said they can go through. But we've got the UK and the US military now doing overwatch actions to open shipping lanes, but none of the US or UK ships can use those lanes because they can't get insurance, but they're protecting the shipping of the Chinese and the Russians. So this is all upside down. US assets, UK assets, US men and women in the navies of the US and the Royal Navy are putting their lives at risk to protect Chinese and Russian shipping, while US, UK, and Israeli shipping goes around Africa. So this is how upside down this is. President Biden was asked about it over the weekend, and he said, and the reporter asked him, is the attacks against the ship, against the Houthis opening up shipping in the Red Sea? And he said no. And then they said, well, will the attacks continue? The reporter asked President Biden, and he said yes. So you just said the policy is not opening shipping, but you're going to keep doing it. And the answer is, when does shipping get open? When the insurers tell the shipping companies it's not going to cost you $3 million to send your ship through, because they've got a lot of risk. They can't take a $3 million or $2.5 million insurance policy knowing that the Houthis are going to shoot at these ships. They might get lucky. They might sink one of these, and then they got to pay out $300 million. The insurance companies do. So this is the thing that I think people need to understand. The audience is the insurance companies. The goal is to get the insurance companies to bring down these rates. They're not only not bringing down the rates, they're not even writing them for US, UK, and Israel. We are a ways away, and the president said what they're doing is not working, but they're going to continue to do it because they don't know what else to do. So as long as this looks open-ended and it continues, it means everybody gets everything they want late. And if it's late in a just-in-time inventory world, it will create bottlenecks and shortages, and it will create higher prices. It will create inflation. It will not create 2020 levels of inflation, but it will create more goods inflation over time. And this will be a frustration for anybody talking about how many times the Fed going to rate cut, when is the last mile going to get inflation back to 2%, so we could proclaim that this whole issue is all over. That's going to frustrate that whole narrative in a big way. What is the bull story for this? Something happens in the next week or two that gets the insurers to say, okay, now I'll start writing insurance policies again for the US, UK, Israel, and I'll start lowering my insurance rates so the shippers say, okay, now it's cheaper to go through the Red Sea. We'll turn the ship around and we'll start going through the Red Sea. But as of this recording, that's not happening, and it's not apparent, at least as of this recording. It could become apparent at any moment. But remember now, this is the 10th week since the Houthis have started this, and it's as bad as it's been in any of these 10 weeks right now. So we are looking at disruptions and bottlenecks, shortages, production delays, not to the extent of 2020, but to enough of an extent that it's another unforeseen thing that will impact inflation, but this time impact it to the upper end. And maybe that's what we're seeing in interest rates and what we're seeing in the market, because 2 weeks ago, the market was pricing in 7 rate cuts for 2024. Today, it's pricing in 5 rate cuts for 2024. And coincident with that has been inflation break-evens have been rising over the last couple of weeks. Not enough to say that they've broken out, but they're going up because maybe the market's starting to realize this is going to be an inflation problem, not a 2020 problem, but if you want the Fed to cut rates 5 times, any kind of inflation problem is going to be a problem as we look forward from here. So I hope we find a way to fix this problem. Fix defined as insurance rates come down, we could start sending these ships again through the shortest route possible, through the Red Sea, and things start to return to normal. But I don't see it now, but hopefully, something will emerge soon that will tell us that, the end is near, but it isn't apparent right now.
Jim, thank you for your thoughts today, and thank you everyone for joining us. If you have any questions on Arbor Research, Bianco Research, or Arbor Data Science, you can contact us by emailing Gus Handler at gus.handler@arborresearch.com. Thanks again. Have a great day.